All right, welcome everybody to my brand new YouTube experiment, Dad's Financial Corner. My name is Fook, and I'm excited to take you on this journey I'm starting. This channel is something I've been thinking about doing for about 2 years now, and with the encouragement of my wife, who's my personal live streaming guru, I'm dipping my toes into this space to hopefully share some info that I think other dads and moms are also curious about as it relates to family and finances. I hope I can provide you with some interesting thoughts, mistakes you should avoid, and useful information I found as a dad of two young kids trying to figure out and plan our family finances. Now, my intention isn't really to make this a technical channel. Hopefully, it's more about making things simple to understand and asking questions you guys might ask and providing a perspective from someone who's in similar shoes with over 18 years of experience in financial services and insurance planning. Now, before I get into anything, I'm going to include this basic disclaimer about any financial info you hear today or on any of my videos. None of what I share is intended to be a particular recommendation or guarantee of performance for any products or investment vehicles mentioned. Most of what we're going to talk about involves general information about sometimes complex financial tools that involve various levels of risk that you should take into consideration for your own financial planning. And while there are definitely things you can do for yourself, I can't say enough about building up a proper relationship with a trusted financial professionals to help you with certain aspects, such as finding a good financial planner or advisor, maybe a tax advisor as well, and a CPA or attorney. I thought we'd start off today with a topic I've been getting a lot of questions about from many other dads and moms I know with young and not so young kids. I know it's probably something I'll revisit several times. That question is, what do you think is the best way to save up for my kids' education? Now, this question, like many others, has the same answers. It depends. It depends on several factors: your time horizon, your ability to contribute, your tolerance for risk, and of course, tax considerations. But before we get into the hows and whys of deciding, let's talk about the options that are out there for dads and moms to use for education savings and some of their pros and cons. Keep in mind, the main reason why any of these savings vehicles are considered especially useful for education is because of the tax benefits that they provide to the owner or the beneficiary. Now, first off, there are these things called Series AA and I savings bonds. These are issued by the federal government and can be purchased through your bank or through the US Treasury Direct website. Not really as popular nowadays because of their low rates, but their biggest benefit is that it is a very low risk investment. There's no tax deductions for making the investment, but the interest growth on the bonds is tax free so long as you redeem the bonds to pay for qualified education expenses and your income doesn't exceed the federal limitations in the year you redeem them. Now, these savings bonds have evolved over the years, but their modern iteration include options to purchase paper or electronic versions in amounts as low as $25 to as much as $60,000 annually, with a 30-year maturity period and with different rules as to the maximum amounts you can purchase. Now, these bonds have been popular as gifts since the investment is one of the safest vehicles you can have since values are guaranteed by the US government. There are some tax considerations if you aren't using them for education, so definitely talk to a qualified tax advisor before buying them. Next on the list are Coverdell education savings accounts, also known as ESAs. These accounts are more appropriate for maybe lower contribution scenarios and be started by anyone with income of less than $110,000 per year, or if you're married filing jointly, $220,000 a year for any stated beneficiary. Now, you or anyone under the income limit, including grandma, can contribute up to an annual limit of $2,000 per kid. Again, you don't get to deduct your contributions, but growth in the account is tax deferred and withdrawals will be tax free as long as it's used for qualified education expenses. A little known fact about the ESA is that all funds in an ESA account must be distributed by the time the designated beneficiary reaches age 30. So, if for some reason the funds aren't all used by the time your child hits age 30 and you haven't rolled the funds into another Coverdell account for different beneficiary, you might get stuck paying the taxes on the earnings, plus an additional 10% penalty. Now, the third option is currently one of the most popular methods to save, and that's through a Section 529 qualified tuition plan, usually known simply as a 529 plan. Almost every state offers at least one 529 plan, so there are a lot of options out there to consider, and since you aren't limited by which state you reside in or which state your student will attend school in. 529 plans have many benefits for education savers out there, including tax-free growth, tax-free distribution for qualified education expenses, and higher limits that are allowed for annual contributions, though they can be subject to somewhat complicated gift tax rules, and most plans have fun options for investment in the market. Some of the drawbacks for plans are maximum aggregate limits imposed by the state, which vary from state to state. ranging from $235,000 to $529,000. And that means you'll need to make a lot of careful decisions in choosing the right plan for your family's particular situation. Also, 529 plans count as assets when applying for FAFSA. So other aid that you might be applying for could be affected by how much you have in your 529 plan. Of course, the one other drawback that the three options above share that you really only receive the tax-free benefits from the distribution only if you use it for qualified education expenses. So if your potential student doesn't end up using it, you might get stuck paying the taxes and penalties if you take it out for any other reason, unless you transfer or roll it over to something else. Also, the rules for what qualifies for an education expense differs between the three savings options above. So be aware of what your real use will be to choose the right plan. Now, the last vehicle that is available is possibly the most flexible of the bunch and maybe something most of you have heard about, just not for education planning. And that's using cash value life insurance as a savings vehicle for education planning. Some of the benefits are similar to other options. Growth is tax-free, and properly done withdrawals and distributions are also tax-free, not just for qualified education, but for any reason. And unlike many other assets, the cash value of life insurance plans won't count against you on the FAFSA application. And of course, it provides a death benefit to your family just in case anything sudden and unexpected were to happen to you. Now, the main drawback, on the other hand, is that you have to qualify for the plan with your good health. So not everyone's going to be able to qualify or get it if they have some health or medical issues in their past. And there are some early expenses that need to be considered. So it's definitely not a plan for families with a short horizon for when they need to use the funds. Also, not every plan out there is the same. So talk to a qualified broker or agent to see what plans are available that will give you both protection and growth. Now you can see there's a lot to consider. It's one of the biggest concerns working in the financial industry. And when I was first finding out that I was going to be a dad, it was my big concern as to how I was going to pay for my kids' education. You know, I came from a pretty modest household and I got a pretty good school, but my folks didn't have a lot to contribute to my tuition and housing. Luckily, I was able to qualify for some scholarships and loans and worked out most summers, but I was always worried about whether or not we had enough for tuition and expenses. Now, after finishing my degree, I was saddled with student loans I had to pay back, which honestly took me a long time to pay off. With our planning, my hope is that my boys wouldn't have to worry about that if they got to college, so that they could just focus on their academics, developing themselves, you know, and if they chose to go to work, it would be to get the experience, not just because of necessity. Anyways, thanks for spending the time with me today. If you learned something new and would like to support our channel, please like and subscribe below. If you have any questions or want to show me some love, leave me a comment below. If you have any questions about your individual situations, email me at dadsfinancialcorner@gmail.com. I'm looking forward to putting together lots more content for all you dads and moms out there looking to make some smart decisions for your family. All right.